everyone. Welcome to the Friday webinar. We have been seeing, time and again, market reminds us after every 4 years, asset allocation is very important. It is like all the more important now, when fear is at its peak. So this Friday, we thought of doing webinar with the fund manager, who heads private credit and, yield investments at ICICI Prudential. So we have with us Jagan from ICICI Prudential, who will discuss today one of the very interesting opportunities that ICICI AMC has been doing for quite some time. And the name ICICI obviously, emanates a lot of trust, especially in fixed income, because in the field of fixed income, trust is very important because here the most important thing is risk and not returns. We're not looking here for maximizing returns, but obviously minimizing the risk. And hence we thought of understanding from Jagan today over this webinar, from his point of view, what is this fund all about? Private credit as an opportunity is something which us are aware of, but how ICICI Prudential does it in terms of minimizing the risk as well as giving, I would say, optimum risk-adjusted returns. Jagan has a presentation today to discuss with us. Jagan brings with him more than 15 years of experience, has been working with ICICI Prudential for quite some time. Over to you, Jagan. Let's maybe start with the presentation. Let's understand from you how has ICICI Prudential doing on the credit funds. And then maybe, once you have done your presentation, we'll understand from the point of view of audience, whatever are the questions and answers. Over to you,
Thanks,
Jagan.
Kamal. Yeah, thanks, Kamal. Thanks for giving the opportunity for helping us to make the presentation on this particular topic. What I will do is for next 30 to 35 minutes, I will take you through some of the salient features of the products which we have from our stable. And once we are done with the presentation, I would like to see some questions on these topics. To start with, let's see how alternate investments has played on has come into the portfolio of the investors over the years. Now there are two popular categories of investments. One is the equities, and the second is the bonds. Now, obviously, equities comes with a higher volatility, and also it brings a higher risk reward. The For the bonds, it comes with a reduced volatility, but also reduced risk reward. Now, what a lot of global investors have realized that how do we try and minimize volatility as well as increase or maybe better the returns with the reduced volatility. That's where alternates as a category has become to form a part of investors' portfolio over the years. And who has been contributing to this alternates pool of capital? It's predominantly the sovereign wealth funds, the family offices, and the ultra HNIs. Alternates includes a wide variety of investment categories, be it a credit category, be it a private equity, or an hedge fund type of capital. Now coming to fixed income specifically, we look at broadly three categories. Yes, one can always have multiple subcategories. How at ICICI Prudential we look at is there is a performing credit space. There is an office yield space which is into commercial properties, and then the last one is the special situations. Now one can look at this category into over a couple of attributes in terms of risk, in terms of liquidity, and in terms of investment horizon or the tenor of the funds. Performing credit is something what we call as investing in businesses or groups which has underlying businesses, however, which needs capital, which cannot be provided by a bank or to some extent a mutual fund or probably even an equity markets. That's one. Office funds is traditionally we look at buying properties whose asset size may not fit into into real estate investment trust, or maybe the family offices cannot buy for scale. The last one is the special situations, which one needs to take a longer horizon call. One needs to look at the risk in a different perspective. One needs to be ready for things. Things can go wrong. Even the normal course of holding the investment. So we believe that performing credit and office yield or a pool of capital which provides adequate returns for the risk which is being taken under these categories. Now, Coming to liquidity, all of them operate under close-ended structures because of the nature of the investments or the type of investments we make through these pools of capital. That is one. However, in terms of time horizon, the performing credit is slightly a medium-term investment horizon. Office yield a bit longer compared to the performing credit, and special situations might be a bit longer, or it might have I would say a medium-term horizon. So when one looks at various investment opportunities in the private capital space, especially in the fixed income private capital space, one needs to look at the risk, one needs to look at the time horizon, and then focus on the returns. Depending on these 3 4 parameters is what one should look at allocation in their investment portfolio, and that is how we at ICICI Prudential have looked at this asset classes. Now, coming specifically to private credit and to the fixed income, we believe fixed income is. What I was referring to in this slide is we believe why fixed income is a very it's a very good asset class to form a part of any investments portfolio.
Your presentation is not visible if you are presenting something.
I hope it's visible now. Come,
No,
hello.
yeah, it's visible now. Please carry on.
Uh, So, in terms of private credit has continued to grow at a very frantic pace globally. Obviously, to one of the prime reasons is to increase the diversification in the portfolio. Second is to offer lower volatility, and third, to slightly better the returns compared to other asset classes. Right, and the pension funds, the sovereign wealth funds are the biggest contributors, or rather the biggest participants in this space. Some of the most prominent managers globally are BlackRock, KKR, Apollo. You have Cerberus, SSJRS, etc. These are the most prominent players in this space. Now, coming to India, private credit is a pool of capital. Now, credit is a lending. Credit at the end of the day is lending. We have various supplies of lending capital, starting with banks. Then we have non-bank financial institutions. We have mutual funds, and then we have the alternate funds. Now, coming to banks and non-bank financial institutions, they are predominantly banks by they are regulated, and they have restrictions in the type of capital they can lend to. For example, banks typically want lend towards working capital or towards setting up capital expenditures. Whereas non-bank financial institutions do have more flexibility in terms of lending against a private equity exit or a merger and acquisition, or against promoter or towards promoter financing backed by shares, land, etc. Still, the pool of capital is not large enough to uh, to cater to this space. The same goes for mutual funds. Mutual funds have I would say, a different restriction. A mutual fund is an open structure in which the liability is almost overnight, whereas the assets we make in the private capital space typically are illiquid. But mutual funds can finance transactions or investments which a bank may not be allowed to finance, like an acquisition or a buyout, etc., etc. These pools of capital have started to dwindle from these traditional sources. On the other side, investors have taken over these pools of capital. Now, investors can directly make an investments or via pooled vehicles like a fund. This is how the evolution in the private credit has happened over the last 15 to 20 years. Now, where exactly we fit in the bucket? This chart shows where the banks are there, where the mutual funds participate, where the NBFCs are there, and where the private credit fits in. Now you can see the private credit fits anywhere between 100 crores to almost 750 to 1,000 crores, and it's between 12 to 16%. Now, beyond 16%, there are funds which also may come under private credit, but they are of different nature. What kind of nature they are? They can be turnaround funds, they can be distressed funds, they can be high yield real estate funds, and also venture debt funds. Private credit encompasses all these opportunities. However, we are talking of a space which is between 12 to 16%, which is called as the performing private credit. The competition to this space traditionally comes from NBFCs and also from foreign banks and also from the FAs through foreign banks. And what we are seeing over the spaces, there is a boom in terms of the size as well as in terms of the deal. I'm not going to bore you with too much of data, but what I'm trying to say is the performing credit space has tremendously increased in scope and in value over the last 5 to 7 years, both in terms of the availability of pool of capital as well as in terms of the deals as well as in terms of the sources of the pool of capital, be it domestic or global. And traditionally, we see a lot of transactions between 50 to $100 million. Even though on the right hand side portion of this presentation, you see greater than $100 million transactions, but those transactions are typically taken over by the global funds. Now, what has made us believe in credit as an asset class? There are quite a few regulatory reforms which has happened over the last decade. The foremost is the insolvency and the bankruptcy code. Here, I'd like to spend a minute or half a minute on this specific topic. IBC has been there in existence for almost now 9 or close to a decade or 9 years. There has been close to 36 to 37,000 cases which has been filed with IBC as of last year. Almost 8,000 cases have been admitted, but there has been almost 28,000 cases which has been withdrawn before the cases got admitted. Now, what this means is, thanks to the advent of this regulation of this legislation or regulation, it has brought in a financial discipline to a lot of corporates. Corporates now believe that if you don't make the payments to either to a financial creditor or operating creditor, there is a chance they may lose the company or the group, and that has brought in a bit of brought in financial discipline to the corporate borrowers, and that is clearly reflected in the data which has been filed with the NCLT courts. And second, the governments have set up NCLTs enclaves to expedite the resolution of conflicts and queries. Now, I'll give another data. With this 8,000 case which got admitted to the NCLT through IBC route, almost 75% of the cases has been settled or resolved or withdrawn after going through the process. Then the governments have set up a bad bank through NARCL, and they have also eased in terms of receipt of capital through the GIFT City regulations, including favorable tax regimes. So, if one looks at combined, there has been with advent of the right set of regulations, with a proven track record in terms of how the regulations have brought in a financial discipline, and also the ease of capital coming through the GIFT City, it has made credit has become a space which we believe is it's in a better shape than what it was 10 years or 15 years back. That's what we believe as we stand today. Now, so far I have talked of the supply of capital, or rather the of the traditional source of capital. But what fuels the demand? The demand typically comes from the promoter financing, either to grow other businesses, like like setting up of alternate businesses. That is one, or through provide equity to their to the capital expenditure, or to provide access to private equity investors and to carry out M&A activities. Now, this is what fuels the demand in the private credit space. There are different pools of capital which can finance this, and there are pools of capital which cannot finance this. So that is the bridge which the private credit today fills. It's a non-dilutive pool of capital, it's a flexible pool of capital, and it's a customized pool of capital. What do I mean by non-dilutive? It's a bridge to equity, it's a mezzanine financing, it's a pre-IPO financing. One can give exit to a private equity investor by taking another private equity investment. One can do an M&A by bringing in equity investments, but those are dilutive in nature, right? So private credit fulfills the need by being non-dilutive. Second, private credit enables you to raise money either at the operating company itself or the holding company of the operating company, and the nature of the instrument can be either a back-ended investment or a redemption or a bullet instrument. The reason why is a private credit is customized to match the cash flows, right? So hence a private credit is a vehicle which can enable this demand to be fulfilled against the traditional sources of capital getting dwindled over a period of time. I hope I'm clear at this point of time. This is a space which is growing. This is a capital which is a necessity, and it's a capital which globally has become bigger and bigger due to the demand which is due to demand which is required for the sponsors. Now, where exactly we as an institution raise capital? So again, a chart which plots from 10 to 12% returns to 18% plus returns. We believe the shaded portion is where the right risk reward is there for us as an institution. So we have raised capital across two funds, and we have launched a third fund recently. We have raised capital and we have lent money to sponsors towards business expansion or a growth capital or an acquisition finance or to give a breather in terms of mismatch in cash flows. That's where we have provided capital. I'll come to our strategy. We have laid out certain boundary parameters from an investment standpoint, and under no circumstance we would not like to breach this from an investment standpoint. First and foremost, when we want to lend money or to give money to any business or a group, we look at the promoters or the sponsors. Now, we believe a promoter's intention to pay is very critical vis-a-vis an ability to pay. A business can always go through cycles depending on liquidity or macro environment or even micro environment, or in certain instances like pandemic where a lot of businesses got hurt. But what we believe is more critical is the promoter's intention, and how has he behaved with lenders in the past, how has he conducted himself with across his stakeholders. That is something we look at it with a very fine lens, and we spend a lot of time in terms of due diligence on the promoters. The second aspect is we like to lend to businesses or groups which has been there for at least 10 to 12 years. In fact, across both my funds, the lowest vintage companies at least is 14 years old, and it is an asset heavy business, a hotel business. That's two. The third point is we like to originate transactions from in-house. We have a lot of capabilities across the as a house. We deal with a wide variety of groups and companies, and hence we believe that origination is something which is very crucial to this business. A lot of times the sponsors, the promoters uh, are not aware of pools of capital. They end up doing dilution in their stake, or they end up taking a very high cost debt. So we spend a lot of time working with the sponsors to do direct originations, and we believe that's a moat which cannot be replicated unless one spends time on the ground. Cash flows. Once we make an investment, once we like the sponsors, once we like the business, once we are underwritten the credit, we have to know how is the money going to be paid back. What is the planning? Is it going to come from the operating cash flows? Is it going to come from a sale of an asset, or is it going to come from the listing of the company, etc., etc.? One needs to know. One needs to ensure that those covenants or those principles are adhered to at the time of post the underwriting of the investment. Last but not the least, collateral is very critical from any investment standpoint, at least from a fixed income perspective. Now, the type and the size of the collateral will depend on the risk which has been taken to underwrite the paper. Now, we have taken land as a collateral. We have taken listed shares as a collateral, mix of both these two, and also unlisted shares as collateral. We have taken covers ranging from 1 time to 2 times or 3 times. Again, it purely depends on the risk which is underwritten and the sponsor group and where we have lent money to. What we would like to avoid is greenfield projects or project execution risk. The simple reason being the fund tenure is typically between 4 to 4.5 years, of which almost 12 to 18 months goes on raising capital, and that means that the residual fund life is 3 to 3.5 years, and hence execution risk is something which we would like to avoid. Naturally, we are not a distressed fund or leverage or a turnaround fund. We focus on the performing credit space. We prefer to avoid asset-light businesses, especially businesses which have high working capital cycle. And there are certain sectors we like to avoid, like trading, EPC, jewelry, microfinance. I'm not saying they are bad sectors or good sectors. I'm just saying that we prefer avoiding the sectors, because we believe in asset heavy business. We believe in the we believe in the touch and feel businesses, be it logistics, infrastructure, pharma, and to some extent warehousing, etc. Last but not the least, we definitely would like to avoid the groups which has caused economic loss to lenders. That is something which we believe it's a red line, and we would like to avoid dealing with those groups. So this is the boundary parameters in which we sit, and every deal which we do has to fit within these parameters, and that's something we take it extremely serious. This business is all about having the discipline, much like we say, that the borrower should be disciplined in taking capital. We also, as a fund manager and as a house, we would like to be disciplined in making investments, because it is very critical in the credit space, as we don't have stop loss, unlike we have in equity markets. That covers the credit portion of my presentation. I would like to spend a few minutes on the real estate side, commercial real estate specifically. Uh, the reason why I like to cover this space is, we believe this is also a space which can give us steady returns, and with a measured risk reward index. Now, why we believe India is a great place for commercial asset class? First, availability of talent. Now, when I'm saying talent, there are two parameters. One is in terms of discipline. We have talent coming across in engineering, IT, commerce management, science, and few other categories. Second is the cost. We Compared to the global professionals, Indian professionals are probably one tenth, or maybe around one tenth of the salary compared to global tech professionals. That's on talent. Second, in terms of commercial property as an asset class, India's rentals are $1 to $2 compared to global office rentals. I'm sure most of you guys look at global commercial rental yields and how they feel that it's oversupplied and the rentals are going to come down. Despite that, India is still, I would say, a very very cost effective in terms of rental yields. And last but not the least, the rise of the global capability centers of the MNC companies in India has contributed to growth of the corporate or the commercial space in our country, which I will show it in the next slide. How the office space has grown almost to two to two and a half times over the last 10 years, and we still expect the growth to continue over the next 5 to 7 years. Despite this growth, the growth in rentals is also sustained over the last 10 years. Maybe not for Mumbai and Delhi, but having said that, here I would like to point out that there are micro markets which are sustaining growth yields. Now, commercial asset class is a space where micro markets very critical in terms of the ability to support the rental yields, in terms of the ability to turn over the assets, in terms of the ability to retain your clients. And this has been proven by data. Also, we have pre-COVID data, we have the COVID data, and we have post-COVID data. As you can see, the supply demand, to a large extent, is the supply is being absorbed by the demand, and the yields have not significantly changed between calendar year 2018 and calendar year 2023. Yes, there was a dip during those two COVID years when work from home was very prevalent and a few companies cut costs. But the global clients, they still retain the space, which has proved beneficial to them when employees started resuming office. Now, again, commercial property one can split in terms of size. One can look at 100 crores, 100 to 500 crores or 600 crores, and above 500 crores. No, above 500 crores assets is typically picked up by the global institutional investors, be it a REIT or a global private equity investors, or funds which wants to accumulate this as an asset class and then subsequently do a listing. Here the capital is very high, and here the quality of tenants are also blue chip clients. Then there's a sub 100 crores 100 crore commercial properties which are typically picked up by the family offices or the ultra HNIs to get a steady cash flows on annual basis. The ICICI has a fund in which we target this 100 to 500 crores in a Cat 2 fund category, where we buy these assets, where we pick assets in micro markets, typically the four metro cities, then Pune and Hyderabad. We pick this, and also Bangalore. We pick commercial properties in these localities. We look at the stickiness of the tenants. We look at the micro markets, and we look at who could be a potential buyers 3 years or 4 years or 5 years down the line. Right. Now, this is a space where we believe the capital is not sufficiently available for a lot of developers to flip their assets, and that's a space we target. Now, again, this is a space where the rental yields is not significantly different from the right hand side portion of the space. This is a space where the quality of tenants is also A grade tenants. This is a space where after 5 years, where the asset value might increase thanks to any micro market improvements. At the same time, it might also increase due to any rental escalations, and we have an ability to flip these assets to institutional investors. Now, we have done this. We have been doing this asset class for almost a decade. We have already two funds, and this is a third fund. We have flipped assets in the past 5 to 7 years. So we have the capability, and we believe this is an undertapped space in the commercial property. We believe we can generate adequate returns, subject to the risk reward of the micro markets. And one last point from my side on this space is we also take leverage in this asset class, that further aids the returns of the investors. So the key takeaway is very simple. As an institution, we believe fixed income is an asset class which should be core and which should form part of any investment portfolio. It offers diversification as well as a low volatility. And globally, we are seeing the trend towards fixed income and alternate assets. And at ICICI Prudential, we have two funds in these categories. One is the office fund, which aims to invest in pre-leased commercial properties. And the second one is the performing credit fund, in which we invest in sound businesses backed by quality sponsors. That's from my side. I hope I have been able to explain clearly what we offer and how do we look at this space, and how do we look at this asset class. Thank you once again for giving us the opportunity. Over to you, Kamal.
Perfect, Jagan. So, as you would have seen, I have kind of, while you were giving presentation, I had run some polls. So 83% of the audience has not ever invested in private credit funds. It's first time that they're investing. And I can understand, because equity markets are like going through volatile times, and times are like reminding every investor of asset allocation. And not every investor would be as gung-ho as he was, like, in the last bull run for investing in equities. And hence it is like a reminder to investors that one should not allocate everything to equities, but one should definitely do asset allocation, and credit has its own space.
Correct.
For HNI clients, ultra HNI clients, private credit offers a decent opportunity.
Absolutely.
But if we talk about basics, how these private credit funds, in terms of return expectations, net of fees, net of taxes, are different from traditional products.
Correct.
Let's first discuss about basics. This is the first question I want you to address.
Okay. So a credit fund, as I can see the queries, a credit fund comes with few risks. The first and foremost is the credit risk. Whatever every due diligence done in terms of promoters, in terms of business, in terms of security, in terms of cash flows, there is still an element of credit risk. So what is critical in terms of credit risk is the checks and balances involved in the underwriting of credit risk. The second is the monitoring. there needs to be adequate monitoring done at a regular frequency. It's one should not make an investment and wait for the investor and wait for the borrowers to return the capital. One needs to track the investments at a regular frequency. It can be monthly, it can be quarterly, but not beyond that. That is one. So how do we track? One can look at the financials, one can look at the credit rating, and if it's a listed company, you can look at how the competitors are behaving. One also needs to understand the industry. Credit, like equity, needs to be tracked on a regular basis. Only then you will be able to you can get ahead of the risk and mitigate the risk. That we believe is very critical from credit from a risk standpoint. And hence, when we as an institution, when we underwrite credit risk, we want to put certain guardrails that there should be sector limits, there should be a group limits, and people, and there should be time horizon. One needs to manage the cash flows in such a way that tomorrow you don't structure an investment and then feel that I should have structured it differently. So where as and when required, take a legal advisor or a tax advisor on board to structure the investment properly. That is one. Second, in terms of liquidity risk, the depth is very low in our country. So one needs to hold till the maturity of the fund. Third, a credit should be looked at. One cannot underwrite a credit fund for 7 or 8 years because businesses don't compound at the same return as the investments which we make. So you should know which pool of capital can give what type of money. Right. I mentioned in the slide there is a special situation fund. Now that can have a different risk reward, and it comes with a risk appetite where it needs to be where the fund manager needs to sit with the borrowers and to run the show. May not be the case in our space. So these are the risks which I think which we believe is very critical from a credit perspective. Checks and balances when we underwrite, portfolio monitoring, and if there is any breach or any covenants, immediately do a course correction. Market risk, liquid risk is very limited in this space because these are closed-ended structures, and obviously concentration risk can be mitigated through sector limits as well as through group limits. This is broadly the risk we look. Tax risk is not much relevant in this space because most of the vehicles are Cat 2 vehicles, and hence it's passed through. And whatever the MMR that's applicable to the investors. So not much can be done in terms of tax.
Sure, Jagan. So if we were to compare traditional products, ultra short-term funds, or you could say medium-term bond funds or credit funds, which are like on the mutual fund platforms, and
Sure.
compare that with your two offerings that we have discussed, would you like to share the difference in the returns that one can expect and your track record also?
Yeah. So mutual fund, let's compare a medium-term bond fund or a credit risk fund. The returns will vary anywhere between 8.5% to 9%, and the expense ratio, once you break the expense ratio with indexation going out of the window, it's 7.5% to 8% is your pre-tax post expense returns. Right now, being an open-ended fund, one can withdraw the returns at any point of time, subject to any exit load which is present in those funds. But then you carry the market risk, subject to the market risk. Whereas the closed-ended fund structures, my two current offerings are between 13.5 to 14. There is a management fee depending on the size of the commitments which is come into the fund. There is a GST on top of it, and then it's operating expenses. So if I were to assume the highest tax rate for both these categories, the delta will be between 2 to 2.5% spread. But naturally, that comes with the the increased risk which is being carried out in my two offerings. Let me be very clear. If someone is if a borrower, however good the borrower, is still borrowing between 13 to 14 or 15%, there is a risk which is involved, and that is a risk, and the risk needs to be underwritten properly and needs to be monitored properly. I cannot stress myself again to say that risk needs to be underwritten and monitored properly. It is extremely critical when one underwrites these investments, and hence we always recommend these two funds as an allocation portfolio and not as a lump sum portfolio. It has to be an allocation. It has to suit to the investor's requirements, and in that context is what the percentage of allocation should be carried out.
Sure, Jagan, absolutely. So we have an audience of HNI, ultra HNI clients who understand risk and who, are obviously, I would say, aware of, the traditional mutual funds. They're wanting to learn and adopt meaningful risk for, you can say, 200 basis points of additional return, which these funds have a potential to offer. But
Correct.
obviously, everybody understands that that comes at a definite, liquidity risk, and then you guys are here to manage that risk professionally. But
Correct.
when it comes to taking risk, it is also important to understand the timing. Right now at these market environment where we know these are uncertain times,
Correct.
and with regards to debt funds also, I'm sure the environment in terms of interest rates, in terms of the geopolitical environment and other macro factors. How does this current present environment, I would say, convey, if you put yourself in investor's shoe, if you are to invest in your own private credit fund, in terms of market timing, how would you ascertain that? Imagine that there is an asset allocation gap and requirement for an investor to invest in debt, and he takes a decision to invest in the private credit space, and hence, he asks this question from you: should I do it right now or should I wait? Is this
Okay.
current environment, how do you see the market environment kind of, uh, driving the risk and reward in this particular space?
Okay. So we have been deploying this fund for last 4 years, and there has been and starting from COVID times. So credit, to a large extent, I will not say it's immune from the global factors. Businesses will be impacted by global factors, and one cannot say that this sector will not be impacted, that sector will not be impacted. We have seen a pharma or a supply chain or even infrastructure can be impacted due to commodity prices. So in terms of timing, this today the interest rates have fallen down. Having said that, private credit is a space which is not driven by, it's not necessarily driven by interest rate scenario. It is driven by availability of pool of capital. There were points of time over the last 2 to 3 years when the equity markets were booming, where borrowers were happy to raise money from the equity markets than from the credit space. Right now, that's the time we were very cautious because everyone was raising capital, and we were not sure who's raising capital, who cannot raise capital. So when we are taking a call, we don't or to a large extent we don't bank on equity markets as our primary source of exit unless we are absolutely certain 30 to 40 days is going to happen. Where we bank upon as a fund manager, as a fund house, is what is the promote, what does the group has, where is does he have cash flows beyond any third party equity, beyond any third party money coming in? Is there sufficient cash flows available? Does the promoter have a lot of assets in his capabilities to sell or monetize? And how is the leverage in the business? Now, if one were to look at all these factors, I think one can underwrite, one can take the risk subject to any geopolitical or macro risk. Having said that, we have also walked away from transactions in certain circumstances. For example, when the Russia-Ukraine war happened, there were transactions we walked away because we believe that these businesses can be subject to those geopolitical risks. So you have to note we have walked away from that. So those risks, Kamal, will always be there, and that you cannot eliminate those risks. But there are if you were to take the call, if you were to conduct a due diligence on the business, if you were to conduct a due diligence of promoters, and if you were to look at a 3 to 4 year horizon, I think subject to the I think we've put in the right security structures, right cash flow mechanisms. I think you can still underwrite the risks. Timing wise, I will not say it, yesterday was get better, yesterday was not good, today is good, and tomorrow is not good. This is an allocation product, so it has to be looked at only from that perspective. I will not say today is the best time and last year was not the best time and next year is not the best time. I will not say that. That is not the right way to look at this category. Yes, there will be a bit of spread bump up, 50 bips or 75 bips, but there is also risk element involved. To reiterate again, this category has to be looked at only from the lens of risk and allocation, not from a timing perspective, and definitely not from one cannot time the geopolitical risk. One can never time the geopolitical risk. What comes in geopolitics is something we don't have control over it. But you can you But I believe that one should start factoring geopolitical risk as a crucial risk component going forward, which has been seen since 2020. It's no more a hypothetical risk. It's a real risk now.
Absolutely, Jagan. You have kind of given a very elaborate answer. Brilliant. As we do benchmarking of various other funds in private credit space, also there is a competition. There are many other funds and various styles of investing.
Correct.
How do you benchmark your fund? How does one say that this fund of yours is like beating the benchmark or meeting the benchmark or is doing really well? If from investor point of view has to select, how does the investor measure and select this?
Okay. Again, in terms of it depends on the portfolio, Kamal, one has. Right now, there are certain groups where you lend money, you get a certain level of returns. Now, the probability of default and the structure you underwritten is what drives the returns. The benchmark will vary depending on the style of the fund manager. Well, I would say we do have a consistent benchmark in mutual fund debt schemes. Whereas in the private credit fund, there is no such. Uh, I would like to say that there's no. We're not evolved. The benchmark is not yet evolved yet, because most of the private credit funds have started over the last 5 to 6 years. So the benchmark will evolve. At this point of time, one has to look at the portfolio. One has to see how's the portfolio built up over the period of time. What has been the track record in terms of the how the portfolio has evolved. For example, in my first fund, I had almost 50% of investments which had a rating, which had a credit upgrade, be it in terms of rating upgrade or be in terms of early prepayment, early repayment, or in terms of leverage getting reduced significantly. I look at that as my parameter. I look at my fund. I look at the fund as something. If I given money for 4 years and if the money is come back in 2 to 2.5 years, that means the underwriting thesis has been correct. Right. That's how we look at it. Now, if you're asking me what is a benchmark, I don't have an answer to it because the benchmark will evolve at this point of time, and the benchmark will vary on the style of the investing or the fund. We believe 13 to 14 or 13 to 14 and a half is the right is what suits our style of investment, is what suits my investment strategy, and that is where that is where we can operate. So I can see some queries. If I may, Kamal, quickly answer some of these queries, if you
Please,
don't
please
mind.
go ahead. Yeah, please go ahead.
So this is a this is a close-ended fund. Open-ended will not help in the will not help in the will not help the fund manager in making the right decisions because of the illiquidity of the investments we make, and that's the same restriction which we saw in the mutual fund schemes also. In terms of the return profile, we target somewhere between 13 to 14 at a gross level. The lock-in period is 4.5 years on a door-to-door basis, but typically the weighted average duration will be 3 years because these funds will call capital over a 12 to 18-month period once we have the investments in place, correct? And then we'll start returning capital once the investment starts mature. So the door-to-door might be 4 to 4.5 years, whereas the weighted average duration will be between 3 to 3.5 years. And when I mentioned 13 to 14% gross, it's at an investor level, and depending on when the investor is entered in, the returns will vary. Right, and investors come in first might have different returns, and investors come in last might have different returns. We have two funds. The first fund is almost 1580 crores. We have returned almost 80% of the capital. The second fund is expected to touch around 2100 crores, of which we have called for 90% of capital. We are deploying. We have recently launched a third fund. We expect that we'll do the fundraise over the next 1 or 2 months. We'll be out in the markets. I mean, these are some of the queries which I can see.
Sure, Jagan. So tell me one more thing. Normally for any fund manager and any investment committee, there is a list of do's and don'ts.
Correct.
Especially in this case, because this is more of a risk minimization and more of a optimum return and allocation oriented product, as you mentioned. Investors are not wanting you to generate the maximum possible returns because this is not a venture debt fund. It's a performing credit fund where risk is very important. What is the list of do's and don'ts which you guys follow in terms of sectors, in terms of the overall deal structuring. You could take example also and maybe explain this.
Yeah. Okay. So I think I explained briefly in one of the earliest presentations. We first and foremost, for us, we do not want to deal with business or promoter groups which has had economic losses to lenders. We to a large extent we focus on the promoters' willfulness more than ability. We focus on asset heavy businesses, very critical. We don't take calls on execution risks, because the fund does not have a time to wait for the projects to get completed and the capital to return back. That is true. We focus a lot on how the money is going to come back. Very very critical to us. How the money, uh, and we will follow that to what the promoters or the business groups has committed to us. If they're told in 6 months we will do this event, we'll check with them at the end of the third month what is the status of the event. At the end of the fourth month, where is the event? Fifth month and the sixth month, if the things are not happening, then we will check with our borrower that what is the plan B. This has not happened. We have an independent credit team. I have an independent credit team which looks at look at all my investments. We have an independent legal team which goes through every document. If I'm going to seek a guarantee from so and so person or a so and so company, we look at all the constitution documents so as to ensure that the documents are in order. And we also have an expert panel to gentlemen to ensure that what we put out for investments has gone through the rigors, so that there's no sentimentality involved in the decision making. We want to be absolutely objective in making investments. That's why the team is also structured in such a way that there are four senior people, including Shekhar, myself, and two other senior colleagues, to ensure that everyone has a view on the investments, and there's no bias crept into investments. These are the checks and the balances which we have put into our funds, uh, to uh, to prevent any subjectiveness or qualitativeness into our final investments.
Sure, Jagan. So we are moving to the last 5 minutes of our questions. I'm just trying to moderate this from investors' point of view. Since this is a closed-ended fund, investors would also want to know, over a tenure of say 5-6 years of this fund, what is the kind of frequency of communication, the process that you follow? Because this is a third fund, I'm sure your process would also evolve based on your learnings.
Correct, correct.
In between, if for example there is any default, I'm sure nothing has happened in the past, but in future, if for example any delay in coupon payment is happening, or whatever is the kind of a yield which is coming in the hands of investors, how do you communicate that the risk and the return, both in terms of updates to the investors?
Okay. We do. There are broadly three kinds of communications we do. One is at a quarterly level, we communicate what is our portfolio. That is one we do. Second, we also communicate whenever there is a deal, whenever there's an investment made, we communicate to investment what is the investments, and in the quarterly and in the annual updates, we communicate what is the status of each deal, what is the distribution made to the investors. And touch wood, God's grace, we have not had any delays or defaults in our payments yet. So we are not we not at reached a space yet, but we believe in a straight communication to our investors. Investors need to know what is happening in the fund. They are the backbone of our funds, and that is extremely critical to us. We have also evolved over the last 3 to 4 years in terms of communication, what is necessary from investor standpoint, both in terms of not only in terms of investment communication, but also in terms of return communications or tax communications, etc., etc. So we are also evolving, and we are adding more and more layers of information in terms of communication basis the feedback which is received from our investors. That's something I take it seriously. Not only I, my team, my entire ecosystem takes it seriously, because the fund can grow to a size and a scale only on investors, investor strengths.
Sure. Just moving on to the last set of questions.
So there's a question on returns. These are all debt returns. We return most of the payouts as interest returns. We do not. The fund does not do a lot of trading, and also we have very limited capital gains. So these are all hold to maturity investments. We are not in the business of trading. Yes, occasionally there might be one or two instances where we might get where if we get a very good yield, we might sell. But beyond that, these are held to maturity investments, so most of the returns will be in the nature of interest income only, and that would mean that they'll become as debt income.
Sure, sure. In terms of alignment of interest, what is your skin in the game, your sponsor group commitment, investment
Yeah,
commitment, can you please share something on
yeah.
that?
So in the first fund as a sponsor, we are put in almost close to 20% of the external commitments. In the second fund also, we have put a sizable amount of almost I would say close to 200 crores as a sponsor commitment. We believe that there's no right to win in this. We have to demonstrate how we have to demonstrate that we are capable, we are competent, and we have delivered. We have returned the capital back to investors, and then we'll come back to the investors in terms of future funds. So across both the funds, we have put a sizable commitments. Considering the SEBI's requirement is 200% of 5 crores, whichever is lower, we have put more than the SEBI's requirements, and we believe that this is a great asset class from our perspective in terms of risk reward.
Sure. In terms of diversification, how diversified is the portfolio in terms of number of allocations, number of
So
companies that you.
we typically, as I told you, sector limit is 20%. There's no regulatory prescribed limit, but we have put a self-imposed limit of 20%. In terms of number of investments, we will be somewhere between 12 to 15 investments, or maybe 16, depending on the fund. This purely depends on the fund size. If the fund size is 15 or 16, of course, maybe 12 to 13. If the fund size is slightly larger, then the number of investments might go up higher. But it won't be too diversified. It won't be to the extent of 2 to 3%. That's not how credit space works, because if I have to target quality promoters, size also has to matter, and that will be starting somewhere between 75 to 100 crores as a base size. Can there be some investment lower than this? Yes, once or twice it can be, but typically 75 to 150 crores, or as the fund grows, maybe up to 200 crores will be the investment size.
So this is the last question, Jagan. I'm sure before allocating some to a particular company, you do a due diligence and you have
Correct.
discussed the entire process. But after investment has been done, what is the process? How do you understand? How do you kind of keep the confidence going that the credit worthiness continues? And if at all credit worthiness goes down, how do you assess that?
Okay. So as I told you, we conduct a quarterly review with both my credit team as well as with my expert panel members. And internally within my team, I conduct a monthly review, and we see what has deteriorated, if any. If something has deteriorated, we immediately sit across with the borrower to see how do we rectify this. Now, we do not wait till the fund, we do not wait till the investment to mature to find out that this is deteriorated, right? And that is the only way to prevent, to identify red flags. And we also speak to a lot of, I would say, we speak to people in the market to see how is the industry doing. For example, if I give money to a cement industry, I speak to other participants in cement industry in a particular region to see how is the industry doing. We take a lot of market feedback. We occasionally speak to other lenders also to understand how is the company doing, and then we see, if you find a red flag, we immediately take a course correction. In the past, we had seen one or two cases where we gave money to textile company. There was a deterioration, but we did not wait for the things to deteriorate. We immediately said this is what it is, and we found a solution to it. And thankfully that was more of a quarterly blip than a permanent blip. But we did not wait for something to have a wait for things to deteriorate materially, and then sit across with the borrower groups. So we are very proactive in that, and we believe that is the only way to mitigate risk. You are absolutely right. It's not just making investments. What goes up, what comes, or what goes after making the investments is extremely critical in this business, especially in the credit business.
Perfect, Jagan. I think it has been really pleasure connecting with you. Before we just wind up, last two questions, from the audience, I could see in the chat box. They want to understand what is the fee structure of the fund and what is the expected net of fees and taxes returns in the hands of investors. Obviously, we are not here committing any returns. This is just an indicative number, that you may want to quote. Which investors may kind of, have an understanding of what they are kind of getting into.
Yeah. In terms of in terms of credit funds, we have a flat fee structure. Flat fee structure. When I mean that, it's only on commitments. There's no carry or catch up or hurdle fee, because we believe this is a space where if I have to deliver the adequate risk reward, or the adequate spread vis-a-vis other alternate options in the market in the fixed income space, a fixed fee structure is the most will it's more suitable in the performing credit space. And it varies between 75 bips to 175 bips, depending on the size of the commitments. That is one. So, and depending on and if I'm targeting a 13 and up to 14 handle, one can expect pre-tax somewhere between 11 to 12 pre-tax, post-expense, post-fee. Again, it varies between investor to investor, both in terms of the size of the commitment and also in terms of the timing of the investments. That's where I expect the fund returns to land up. And the net will vary depending on the the taxation of the investor.
Thank you so much, Jagan, for this detailed webinar, and thank you everyone for joining us today. This is one of very, I would say, successfully running private credit funds. It is important to assess every fund before every investor takes an investment decision. And asset allocation, as I have mentioned in the beginning itself, is very important, and debt also plays a very important role. Within debt, obviously, there are various ways to invest within fixed income. This private credit space, in the performing credit, is something, which is like evolving space. And this space, ICICI Prudential has been doing great. And this is the third fund for which they're raising money. If you guys have any further questions or you want to do any expert conversations, you can book an appointment with us at PMSAIF World. Thank you so much, Jagan, for your time today. Thank you.
Thank you, sir. Thank you. Have a nice day. Have a nice weekend.